The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs.
Did Jamie or Latasha share with you how I do the intros of the speakers?
Negative.
No.
Yes, this is awesome. Okay, great. So I don't read your bios. That's so boring. I search the internet for stuff about you, and then I share it with the members of the CFO Council. And if I can find pictures, I share that too. So those are coming up. That's why I have control of the screen, if you're wondering. All right, let's start with Jonathan in no particular order. He must be getting paid by the word in his title because he is the Managing Director and Senior Macro Strategy Analyst for the Chief Investment Officer with Bank of America. Is that correct, sir?
That is correct.
How does that fit on a business card?
It doesn't, and I don't have any business cards, so there you go.
And I believe you are an officer in the U.S. Navy Reserves?
Yes, sir.
Undergrad in econ from Colgate, MBA, NYU, Executive Masters from Syracuse?
That is correct.
I think, okay, this is where it gets into the think. I think you met your wife at Colgate?
I did. That's good research. That you could be an intelligence.
Married, Lauren, 2 kids, young kids, I think. Is that right?
I just had a third, so the internet's not updated yet. Yep.
That's super awesome. Congratulations. And normally, if I find a runner or athlete, I share your times, but you're way faster than me, so I'm not. All right. I believe you've run a few marathons and you are a decathlete for charities. Is that correct, sir?
I did. It's been a while since I've done marathons, but I do a lot of fitness events for charity. It's definitely a hobby.
I saw some times on a 5K where it looked like it was supposed to be a fun run, but you kind of pulled away, had a little last minute burst and beat your wife. Is that correct?
I may or may not beat my wife every time. I like to run with her. Sometimes she lets me go. And
I think that is your wife and you. Is that correct?
That is, wow.
The internet is forever. Really the internet is forever, folks. I try to tell you. The
Navy could use you.
Dwayne, how are you doing, sir?
I'm a little nervous, actually.
Well, you're depressing because like everything about you is awesome, and I felt worse about myself. I need to get my blank together, okay? All of y'all are going to feel like you have not accomplished much in your life when I'm done with this. Okay, so Dwayne is the Director and Senior Equity Analyst and Chief Investment Officer with Bank of America, who clearly likes long titles. Is that correct, sir?
Love it.
I think you are a long-suffering Giants fan and Knicks fan. Is that correct?
I am, indeed.
Everybody makes some poor choices in life. That's okay. I think you were a high school athlete and played football at, and I'm going to drop the H-bomb, Harvard, for undergrad. Is that correct?
That is correct.
Did you start off as a wide receiver and then end up as a defensive back?
That's exactly right. I couldn't buy myself a pair of hands, so I ended up on the defense.
And I think you were part of the 97 team that went 9-1, undefeated in the Ivy. Is that true?
That's right. We were the Ivy League champs.
I got a question. So would you rather go 2-8 or 8-2? But it meant the only 2 wins or the 2 losses were wins and losses against Yale and Princeton. So what would you rather have, a winning season and lose against Yale and Princeton, or would you rather go 2-8 but at least y'all beat Yale and Princeton?
The latter. You got to beat those guys. Got to beat Yale and Princeton. Those are the 2 games that matter the most.
Because Harvard wasn't enough, I think you also got a MBA from Yale. Is that correct?
Yes, shamefully, yes.
And super volunteer at a bunch of things. I'm not reading them all because it's too many. But one I saw was the Odyssey House, a treatment facility in New York. They provide mental, substance, and other support for folks in New York.
That's right. Been doing that for about 10 years now.
And I think you're married to Erica, and you've got 3 kids. Is that correct?
Yes, that's my family right there.
So, and folks, Erica looks like she's a photographer. I think the owner of maybe Wine and Branch. Did I get that right? And I was looking through the gallery.
Vine and Branch.
Vine. Okay. Well, clearly talented. I was looking through the gallery, even making you look super handsome, which is awesome. And Jamie, Victor, Latasha, luckily, I've run out of time, and I can't share all that I know about you, which, by the way, Jamie, is a lot. Okay, you need to get off the internet. Jonathan, you can take back over now. In just a second, I'll change you should be presenter. You should be able to share, and we'll handle the real meat of the event. As always, folks, as he's bringing that up, use the chat box for questions. I'll be monitoring that, and we'll get this started. Jonathan, I'm going to mute myself, and Dwayne, I'm going to mute you until Jonathan kind of passes the torch during the QA section. I'll bring us back up.
All right, good to go?
Yes, sir.
All right. Good morning, everyone. So I think over the years, I've done a number of CFO leadership events, so it's possible I've spoken to you in the past. With CFOs, I like to talk a lot about the business cycle. If you ever heard me speak before, meaning, you're trying to plan your activities for the next long term. I've been in strategic planning meetings, or short term, meaning potentially investing in capital equipment, or trying to figure out where interest rates are going to go, or trying to figure out when the next recession might be and what it might feel like and what industries might get hit worse than others. So I like to focus a lot on business cycle timing around CFOs, so I hope that's okay. The National Bureau of Economic Research, and an incredibly boring and not surprising media release, said that the pandemic recession was 2 months long. So the shortest recession ever last year, lasted for 2 months, which means we've been in expansion for a year. And so how long is this expansion going to last? If you think about it, compare it to the last one that lasted 11 years, right? The last expansion was pretty slow growth, pretty low inflation and stable. And, for businesses, it was kind of, with the exception of some regulatory and healthcare and policy uncertainty, was pretty stable time relative to what we're seeing now, right? Coming out of the pandemic where forecasts are all over the place, and we're trying to figure out what the next step is. So the way I think about it is the key takeaway is that so much is dependent on inflation and what the Fed does, right? I've been working for a monetarist for too long, and he'll tell you that the Fed is going to determine how long this cycle lasts. So are we going to see another 11-year cycle? Should we be thinking in terms of, hey, we just came out of a recession, we got a long runway? My best guess would be no, that this one's going to be shorter. And so the 2 charts I have just kind of show that because we're doing so much in terms of fiscal and monetary policy to get this thing going, and because this recession was so unique, it's likely that this cycle is just much, much stronger in the beginning, which means it leaves you the potential to build excesses. And when you build excesses in economy, whether that's in certain asset classes, which it's good we have Dwayne on because he'll talk about one of those, or whether it's in the investment sector or on the consumer balance sheet side, when things run so hot, even if it's just for a few years, you tend to create the potential to have a recession. And so I'll go through some of those things. I think if we look at, for example, the consumer, right, coming out of the financial crisis, the consumer was devastated. Obviously on a balance sheet side, home prices were falling, equity prices got smoked. So from a consumer net worth side, they were in tough shape. And they didn't have the fiscal stimulus that we have this time. So consumers this time are essentially locked and loaded, right? It's very unique that we're coming out of a recession or a year out of a recession, and personal incomes are much higher than they would have been than we even predicted pre-pandemic. So just massive amounts of liquidity on consumer balance sheets. And from a financial obligation ratio perspective, meaning like how healthy are consumer balance sheets, in the aggregate, very, very healthy. The cost of debt is low, liquidity is high, and that's not just mortgage debt, right? It's all debt because the Fed has rates locked at zero. So you see it in the personal saving rate, and we're still getting fiscal stimulus, right? Child tax credits just started paying out, and then we're phasing out the unemployment benefits. So the consumer has a runway here where the only bearish commentary you hear is, will they not spend all the excess liquidity fast if things go bad? And so that gives you hope that you could have a multi-year cycle, but that takes you back to inflation, because if they spend it faster, the Fed's going to be thinking, hey, I need to not only take my foot off the accelerator, but I might need to hit the brake hard. And when the Fed hits the brake hard and the market doesn't expect it, then you can generate a recession on that end. On the business side, coming out of the financial crisis, it took till the end of 2011, I think, for corporate profits to come back to the pre-recession level. We're already back and exceeding the profits coming out of the pandemic. Again, massive fiscal stimulus, whether it was PPP packages or just the short-term nature and the pent-up demand or the ability of companies to change their business models. And so you ended up getting a lot of CapEx. And so as we kind of get back to inflation, the businesses will play an important role, because the extent that the pandemic sped up CapEx and investment in productivity enhancing things, that tends to be a buffer it tends to dampen inflation pressures, right? Because you're able to operate, create more output with a smaller number of workers, which is what productivity is. And so the pandemic scared you into doing that, and we're seeing business confidence really high right now, suggesting we'll get more CapEx. Businesses will play an important role in the length of the cycle, because the faster and more efficient the investment cycle is, the CapEx cycle is, the better chance we have of dampening the inflation effects. Think about it in the semiconductor industry, right? You have massive shortages of semiconductors, so used car prices go up. Significant contributor to overall inflation. We need more semiconductors. How fast can we build new plants, create new semiconductors to relieve shortages, to take the pressures off? And any supply chain pressures mean massive demand for labor, which puts upward pressure on wages, which means consumers that already have fiscal money in their pocket and are getting more wages have the ability to drive inflation higher, because inflation has to come from not only you have to have consumers willing to spend, right? You need the turnover of product to generate inflation, which was really missing coming out of the global financial crisis. The Fed and the Biden administration are committed to running this cycle hot. And so I think, again, it all kind of comes back to where are we in terms of inflation in the labor market. And those are the charts that I wanted to show you today, because I really think, as we think about this, in my job, we're focusing on what the Fed is saying, because that's going to signal when they're going to hit the brake. So you heard they're talking about tapering. What does that mean? They're in the initial phases of removing monetary accommodation, but from the perspective of a car, they still have their foot firmly on the gas. And what we're worried about is if they're pushing the economy too hard, and we generate way too much inflation that's not transitory, meaning not from just short-term rebounds and lasting, and they have to, get scared and tighten policy faster. So one way to measure that is to look at what are the prices in the economy that were sensitive to COVID. So whether or not inflation is a short-term thing or a longer-term thing where the Fed's going to have to hit the brake, it is determined by how much inflation we get in the areas of the economy that are unrelated to just COVID. So during COVID, which prices collapsed and how fast did they rebound? Those would be the COVID-sensitive core PCE inflation. So you can see growth rates well above the Fed's 2% target. But the more important part right now is that you're getting the COVID insensitive prices too. So in Bernanke, Chair Powell's testimony this past week, he was talking about whether or not inflation is transitory or lasting, and he's talking about this specifically, the blue line, and how long that's going to run over their target. Now, the Fed has said they want inflation to run hot because they want to be able to prove to the world and financial markets and business owners that they have the ability to get inflation over their target. It gives them credibility. They failed since 2012 to keep inflation over 2%. And credibility matters in central banking. So they're saying they're going to run it hot. So putting all that together from an inflation perspective, it almost sounds like the risk is really that they're going to run it too hot and have to hit the brake. What that means for you as a CFO or a business planner is that there's a chance that you just get more volatile cycles. And so people say, well, what about the 70s when we had high rates of inflation? What was the issue there? The issue was you bounced around recessions. You had more recessions. They were maybe shorter in length, but because inflation was bouncing around, you ended up having some shorter cycles. So will we get an 11-year cycle? This seems to suggest maybe not. The other thing is that more volatile macro variables like growth and inflation. So you're using all these tools, fiscal policy and monetary policy, to make sure growth is strong. More volatile macro variables means more volatile asset classes, right? And especially when you have consumers and businesses with a lot of liquidity, you end up with a lot of money going places because there is a lot of money out there. And so another way a business cycle can end is like it did in 2001, where you have a bursting of asset classes. So if this is not a traditional cycle in the sense that because consumers are so well positioned and businesses have the benefits of low rates and rising profits, if we don't build excesses, how could the cycle end? Well, the cycle could end with massive bubble in certain asset classes, which is what happened in the tech bubble. And I'll remind you that when that recession happened, consumer spending didn't actually collapse, which would make sense to me right now. If we had a recession, consumers are well positioned to buffer that, given the amount of savings they have. So what I'm saying is if the Fed ends up having to tighten policy in 2023 much faster than people ended up in a recession, the consumers will likely be in a pretty decent position, in a defensive position where you won't see as big of a contraction in consumer spending like you would have saw coming out of the financial crisis, just because of the way their balance sheets are set up. What you could see is a massive collapse in business investment spending. And what you could see is certain asset classes that are bubbly bursting. And so in the real economy, it might not feel as bad as for people that are holding those assets, whether it's cryptocurrencies or tech stocks that are running hot or whatever the sector might be. The other piece of this is the labor market. And the Fed obviously has a dual mandate. They have a mandate of stable inflation, stable prices around 2%, and then also full employment. And the unemployment rate in the U.S. is 5.9%, which unanimously, when I talk to CFOs or financial market participants, is not indicative of how tight the labor market is. Everyone I talked to said they're having trouble getting good workers. And so this is basically telling you this labor market is very tight. Now, you don't worry about this. It's how busy it is. The inputs to this, which is showing that we have a labor market that's more tighter than what would be average, so one standard deviation or more tighter, comes from asking small businesses, are they having trouble filling positions? It comes from consumer surveys about employment, are jobs easy to get or hard to get? Comes from layoffs. So the labor market is very, very, very tight. And I say that because if you think ahead to the end of next year, it's possible you have an unemployment rate, because we're probably going to get jobs growth again in the well over 500,000 jobs a month. People coming in the workforce, maybe not fast enough. You could have an unemployment rate next year that has a 3 handle on it, right? So you could have a Fed facing inflation that's been running over its target for multiple years, and an unemployment rate that is like, in the mid 3s even, which is flashing, okay, we need to do something about this. So then, again, another indicator that, hey, the Fed could be tightening policy. Now, the Fed says they're not going to be raising rates till 2023, and that's fine. The biggest risk is that inflation goes much faster because the labor market is so tight and there's so much stimulus in the system, then inflation just runs much, much hotter. How can we mitigate that? What kind of keeps it going? Again, I'll bring it back to CapEx and productivity. How fast can firms offset this labor market tightness by investing in productivity in an environment where corporate rates are pretty low, borrowing rates are low, to generate more output with fewer workers? And I think that's a key piece right now that you play a role in to some extent, but you also have to balance that this is a very volatile cycle because we have massive fiscal policy that could run off, massive monetary policy that could run off. In the meantime, we have a party, right? Businesses operate in a nominal growth environment. So we have higher inflation and higher real growth, which means we have higher sales growth and higher earnings growth, and we're seeing it all right now. And I think the way cycles often end is everyone's making money until they're not, and then confidence collapses. So if I'm pinning this cycle against the global financial crisis or the tech bubble burst, I'm more likely to say this one ends like the 90s cycle, where you get asset class bubbles blowing up, contraction in CapEx, consumers actually do okay. And what's interesting about the 2001 cycle is you actually sowed the seeds for the housing excesses of 2005, because housing is such a long-term demographic sector. While it's cyclical, it might just take a bump, but the underlying things driving housing, which are the millennials moving from the cities to the suburbs, like myself, because I have too many kids and too many darn dogs that I have to move to the suburbs and buy more homes, that is a force that is going to continue to happen. So you could end up, again, with asset classes bursting and you move into a cycle where consumer does okay and home prices take a hit, but the underlying buying power for single family homes is probably still there. Real quick, I'll just talk globally and then I'll turn it over to Dwayne, because if the cycle does end where you have certain asset classes that look bubbly, one thing people talk about is maybe that's in things like cryptocurrencies, or maybe it's in tech stocks. And Dwayne is well versed in equity research and what's happening in the crypto universe and how useful it might be. Globally, look, leading indicators are very strong. I mean, the Bank of America Global Research has a library of proprietary indicators. 95% of them are either neutral or positive. If you go back to COVID, it was like 15%. And that's with the uptick in COVID cases, because vaccination is very uneven, as you know. Not everyone is doing as well as the U.S. In fact, the U.S. and China are really pulling the world along here in terms of global growth, and many countries are kind of teetering on the brink. So the global backdrop drops strong. We're going to get above trend growth this year and next year in the world. We're going to get above trend growth likely this year and next year in the U.S. and probably into 2023. It's really when you get to 2023 where, in my opinion, business cycle risk really picks up. Other risks, other than inflation picking up, obviously COVID. I don't know any more than you all do. I have no training in viruses and how they evolve and what that's going to mean in vaccinations. And vaccinations are very uneven, but to the extent that you could end up with recessions in other parts of the world, then you drag growth down in the U.S. And then, there at some point you worry about a fiscal hangover, or the need to raise taxes to help pay for the increase in balance. For me, for economists generally, the equation about whether debt is sustainable is really based around growth. And right now, growth is so strong and the cost of debt is so low that urgency is probably not a near-term threat, meaning as a country, we're generating revenues very fast and our cost of debt is very low. So we're able to stabilize debt to GDP once we move out of this massive fiscal stimulus. And maybe with that, I can turn it over to Dwayne, because again, I think this cycle, in terms of the way it might end, right, we don't have excesses in the housing market, which created the global financial crisis. We don't have businesses. There's some frothiness or some non-financial leverage building, but cost of debt is very, very low, and the growth environment is very, very strong. So to me, this looks like an asset class thing, and I think technology can get you out of this thing, by creating productivity. In certain industries are benefiting from the massive amounts of liquidity, including cryptocurrencies, which can be a good thing if we put money to work in places that are super helpful to productivity and dampening inflation. So Dwayne, I'll pass it over to you. You can take it over.
Jonathan, I've got a couple of questions for you.
Oh, yeah. Sure.
Before we transition over to Dwayne. I unmuted Dwayne too, so Dwayne, please pop in at any part to add to these comments. Question number one from the chat box was, a couple slides ago, there was a line for COVID sensitivity, inflation, or COVID sensitive. What are some key pieces of that are driving that line up?
The easiest example is used car prices, right? Or anything goods related, right? Or sorry, anything services related where we couldn't do those experiences. So going to a restaurant or airfare. Airfare went from being basically free to being very, very expensive. Probably I'd use airfare as a clear one. So the way they calculated this is they looked at when COVID hit, which prices were most sensitive to the shock, and then they extrapolated that back and forward, and they follow those prices. And so consumers transitioned to spending on goods instead of services, and now they're moving back. But airfare would be a very good one. And then in terms of other transitory prices, like used cars is the one that's just having an enormous impact right now on overall inflation because of the shortage of semiconductors and everything else.
Jonathan, you mentioned everyone's making money until they're not, and that there might see asset class bubbles. Any potential examples of asset classes we should keep an eye on that could be a top three potential for a bubble in the future?
I think with the global financial crisis still fresh in our minds, you always worry about housing, right? Home prices are running at 15% year over year. So you worry about, is there a bubble in home prices? I tell you, my point was mostly that there's a very strong fundamental underpinning to what's happening in housing. And then when you look at, and Dwayne can probably comment on this as well from the bank perspective in terms of the loans that went out. I think during the financial crisis, you had a significant percentage of loans that were adjustable rate mortgages. That percentage is much, much smaller. You had financial obligations on mortgages, the ratio of debt to disposable personal income, very high. That's not the case now. Those are very, very low. And so the bubble, and if there's a bubble in home prices, it might not burst in a way that forces deleveraging, which from a macroeconomics perspective is most dangerous when you have the asset bubble burst and you have to delever. So I would probably look beyond housing. Certainly there are some sectors, right, like the tech stocks that obviously are showing valuations that are just enormous. In the private sector, the amount of liquidity searching for deals, right? VC, meaning he ended up with SPACs and all these things. Basically, where can I put my money so that I get in early enough where I make money? And then asset classes that are created, like cryptocurrencies. I'm not saying they are in a bubble, but when you have difficulty deriving an underlying fundamental reason why things go up, then that creates the opportunity for asset classes to go up because of sentiment. That one of my favorite lines is from The Big Short was, it was like a conversation in the movie between Bernanke and Paulson, and it's in the book also. And it was something like, why didn't anybody stop this? And it's because everybody was making money. And when that ends, that's when you get the sentiment free fall. And to me, a lot of that feels like that's happening right now versus me as a macroeconomist looking around saying, oh man, Are we over levered in housing? Are consumers stretching? No. Are businesses stretching? No. People are just have a lot of money, and businesses have a lot of money, and they're trying to find places to put it, at least in the U.S. And to me, that thinks it's going to go somewhere. If it goes to areas that don't deserve it, when people stop making money, it's going to go the other way.
Dwayne, anything to add to that around asset class bubbles?
Not particularly. I would just say that, back in the financial crisis, the comment that Jonathan made about the adjustable rate mortgages is definitely true. There were pick-a-pay loans, all those sorts of things that aren't really a product anymore. And the only thing I would also just highlight is just being a little bit different in terms of how it resolves itself if there is a deleveraging, like Jonathan talked about, is as a result of all the regulation that came in after the financial crisis, a lot of lending has moved outside of the traditional banking system, and it isn't as heavily regulated. So today, the number one mortgage originator is Rocket Mortgage, who doesn't particularly, I don't think, take deposits or anything. So they're not regulated by, all the alphabet soup of regulatory agencies that say Bank of America or JP Morgan is regulated by. And that's just one of the unintended consequences. So to the extent that there is some sort of deleveraging, a lot of it is going to occur outside of the traditional banking system.
I'll pull a couple more, and you can hit me rapid fire with some answers if appropriate, just to go through a couple questions. I got one question on additional to pull a string on the asset class bubbles. We mentioned housing, but what about commercial real estate? Any thought on that as a bubble and maybe demand declining in the future?
Not as a bubble in terms of the macroeconomic sense of investment relative to capital stock. If anything, you had it pulled back because of COVID.
10-year Treasury yields recently dropped. Any thoughts?
Yeah, I think we've talked a lot about that being related to positioning because it's so out of line with what you normally think about a 10-year being tied to growth and inflation prospects, basically nominal growth in this environment. It should be moving higher if inflation and growth are moving up. And so a lot of it is around the bet was so one-sided that rates were going to go up. When it unwinds, it winds hard and ends up finding a floor and then continues the upward trend. The other part of it is the Fed obviously playing a huge role in buying treasuries, right? So we're still, this is the debate happening in the Fed, and this is the debate happening among economists who are critical of the amount of stimulus in the system, that the Fed shouldn't be buying as many treasuries when rates are already low, right? If the Fed's goal is to keep private sector rates low, in the 10 years at 1.2 or 1.3, then in private sector rates are near a record low, then doesn't that leave them room to stop purchasing? Because ultimately we're trying to manage private sector rates to kind of like ease the ebbs and flows of the business cycle. We have to say the path is higher. Obviously, that's just been a wrong bet for 40 years. So it certainly is interesting. I think a lot of it will be determined by the Fed. When the Fed starts tapering, you'll see these tantrums where rates will move higher. And my guess would be, given upward pressure on inflation, that'll start sooner rather than later.
I've got like an infinite number of comments around money supply and the balance sheet, the federal balance sheet, and I'm not going to read them all, but we're a bunch of accountants, so they all basically say, wow, there's been a lot of money supply. M2, I think, is 10 times in the comments, and the federal debt seems high. Could you speak a little bit about that?
That's it. That's the crux of the risk right there, that if you are in the monitor's camp, there inflation is always an everywhere monetary phenomenon, and you get M2, then boom, you are worried about inflation, because historically, pouring that amount of money, the Fed, M2 growth being what it is, and then being monetized by fiscal policy, then you are worried about inflation and you'll position accordingly. I think there's a lot of that happening. So it's certainly worth watching. Certainly on our radar.
I'm going to hold the rest of the questions, and we'll cover some more later. I want to pass the torch to Dwayne. And Dwayne, I appreciate you coming to add some information on crypto. I have a personal just interest and fascination, and from back to dispersed ledgers to blockchain to the financial applications of that technology and cryptocurrency. And I think it's something I would never consider participating in a with my corporate hat on. So it's just fascinating to me every time I read about some company, even like accepting it as a form of payment or doing something with it. I'm always like, what? So I just want to learn. Maybe I fear what I don't know. But I do have a fascination, and I'm really excited to have you share a little bit with us. So I'm going to mute myself, and I look forward to it.
All right, great. Thanks, Robert. So I'm glad we were talking about the great financial crisis before, because that really, you have to remember that Bitcoin, which was the original crypto, was born out of the financial crisis. So you're coming out of the financial crisis. Obviously, the banks had a lot to do with the crashing of the economy, and there was a lot of distrust for banks. There was Occupy Wall Street. Bank was a four-letter word, and at that time, a guy by the name of Satoshi Nakamoto, he invented Bitcoin in 2009, solving for what he described as the inherent weakness of the trust-based model, meaning having a financial institution serving as a trusted third party to process digital payments. So he solved for that, and thinking that what was needed was an electronic payment system based on cryptographic proof instead of trust. And that would allow any two willing parties to transact directly with each other without the need for a trusted third party. And that is basically the origin of the blockchain. So let's just talk about the blockchain really quickly. So if Jonathan and I were, we were transacting again on the Bitcoin network. So I send him money. I send him 5 Bitcoin, and Robert sends me, whatever amount of Bitcoin. Those transactions would get lumped in a block, and so the way to think of it is like a train. You think of it as a train with different cars. So that first set of transactions would be part of that first block. And the way it works is that the network randomly generates a number between 1 and something like 3 million. And everyone who's part of the network are trying to solve for that number, and it's just trial and error. So you just need tremendous amount of computing power. And whoever solves that transaction, they get rewarded. And there's a reward for solving that particular problem. And that is the first car of the train. So that's the block. Then there's a hash that connects you to the next set of transactions. And so the way to think of it is the blockchain is just one long continuous train. It's the blockchain today has every transaction that's happened on the Bitcoin network going back to 2009. And the length and the complexity of the blockchain and the difficulty in recreating it, given the computing power that it would take to recreate all those transactions, is basically the safety of the network. It's not unhackable, but it's mostly virtually unhackable unless you had a tremendous amount of computing power. So that idea of proof of work, meaning that you have the computing power to actually solve that equation, is basically what that blockchain, the Bitcoin network, is based on. That proof of work concept, where you can show that you took X amount of time to solve a problem, because obviously you're going to have pretty sophisticated algorithms running to solve it. There is no central authority that issues Bitcoin. But again, coming out of the financial crisis, you had a Federal Reserve that was printing money. And that was one of the things that the creators of Bitcoin also didn't like. So what they decided to do, was, make a finite amount of Bitcoin. So there's only a maximum amount of 21 million Bitcoins embedded in the network's design. And so the miners bring new coins out into light a few at a time by collecting new transactions in the block and adding them to the blockchain, like I described before. So Bitcoin launched in January of 2009, but with no market price. It only attracted a small group of cryptography enthusiasts. And that changed when the first substantial Bitcoin exchange, a Japanese company known as Mt. Gox, started trading in July of 2010. In April of 2013, Bitcoin's price hit $100 for the first time, and Mt. Gox accounted for 70% of Bitcoin transactions worldwide. By late 2013, Bitcoin's price crossed the $1,000 threshold, increasing tenfold in less than a year. But in February of 2014, Mt. Gox infamously lost roughly 850,000 Bitcoins, or roughly 6% of the circulation at that time, in a security lapse. It was actually a blessing in disguise. Bitcoin's price would drop below $200 and not reach 1,000 again until January of 2017. But after the Mt. Gox collapse, new market infrastructure firms like Bitfinex and Huobi emerged in Hong Kong with much better governance and improved operating models. Coinbase followed suit with a US-based exchange that attracted institutional interest for the first time. The four largest crypto exchanges, Coinbase, Bitstamp, Kraken, and Bitfinex, now account for approximately 90% of US dollar quoted Bitcoin traded. And obviously, since the pandemic started, you've had a lot of volatility. Ether is the second largest cryptocurrency, and I think the one really with more lasting durability. It emerged in 2015, built on top of the open source Ethereum blockchain. Ethereum also uses blockchain technology, but its network runs smart contracts, which enable broad functionality beyond payments. So whereas Bitcoin basically solves for one thing, which is payments, and it's not particularly good at payments, right? So if you look at Bitcoin versus say Visa and MasterCard, the Bitcoin network can handle approximately 14,000 transactions per hour. If you compare that to Visa, Visa can handle 236 million transactions per hour. So it solves for one thing, and it's not particularly good at that, in my opinion. Ethereum also uses blockchain technology, but it has those smart contracts that enable you to create and distribute digital tokens that represent fungible and non-fungible or financial assets that can be verified in this distributed ledger. Given its versatility, an early use case for Ethereum was a vehicle for initial coin offerings, or ICOs. And there was a boom back in 2018. There were $4.6 billion of initial coin offerings. And again, these all happen on the Ethereum network. You might have heard recently of these NFTs, or non-fungible tokens, of art being bought for millions of dollars, or artists have released music on fungible tokens. So there's a broad use case for Ethereum blockchain and Ether cryptocurrency that drives it. And when you hear talk of things like decentralized finance or DeFi, they're all primarily based on the Ethereum network. That's the reason why I think in the long run, given its sort of broad use case and things that I'm sure that we'll be using Ethereum network for in the future that you can't even think about now, are what I think make it by far the most viable in the long run. Estimates range, but today there are literally thousands of cryptocurrencies worldwide, but the most widely traded are Bitcoin, Ether, Litecoin, Bitcoin Cash, Zcash, Basic Attention Token or BOT, US dollar, US digital currencies, and Ether Classic.
So let's talk about just quickly about that proof of work concept, which we talked about before. So there's a lot of computing power that goes into the Bitcoin network, and that is a pretty big negative from an environmental perspective. Mining Bitcoin has a negative carbon footprint. Basically annually it generates the same amount of carbon as small countries like Sweden. And the problem with that is, well, why does that happen? It's because most of the mining happens in China. 70% of the mining happens in China, and 2/3 of China's electricity comes from coal. And as we're starting to move some of the mining out of China, that's going to help. But that's the other reason why I think Ethereum is more viable in the long run, because Ethereum is moving from that proof of work to a proof of stake concept. And the proof of stake is really just ownership. So there won't be these complicated transactions to solve for. It'll simply be, I own X amount of Ether, or I own, this digital token, and I'm willing to, so it's not going to have that electricity use, which is going to dramatically improve its carbon footprint. Central banks around the world, including the ECB, the Fed, and PBOC, are kicking the tires on so-called central bank digital currencies, or CBDC. The idea behind that is that it would give retail users access to a central bank asset. A fundamental difference is that CBDC is intended to be a risk-free liability of a central bank, in contrast to crypto assets, which are not a liability of any entity. Also, there will be a stable coin or a digital representation of the central bank currency. So it's not going to necessarily trade on an exchange or a store of value. It's just really going to be a digital representation of the fiat currency. And it's going to operate on a two-tier system that uses banks to intermediate CBDC accounts in coexistence with commercial bank deposits. Now, there's going to be some issues with this, because one of the things that people, users of Bitcoin or crypto assets, like is the anonymity that goes along with it. That it's very you can basically anonymously transact, which has led to a lot of bad actors being attracted to the currency. These central bank digital currencies, they will be able to track the movement of one digital dollar throughout the entire economy. And there's going to be, I think, some sort of data issues in terms of, privacy and, do I want the Fed knowing exactly where every single dollar is going in the economy, and the movements, there's going to be some issues there potentially. But I think generally speaking, what I would leave you with today is, if you're thinking about use cases potentially, I don't necessarily think, I think a decade from now, we're going to be talking about Ether and Ethereum blockchain and, decentralized finance and the DeFi uses of on that network, and less so about Bitcoin. I think Bitcoin's here to stay. One of the reasons why, but I don't think it's going to be the primary cryptocurrency. And just also one of the reasons why there's a scarcity issue that you see with only the 21 million. We're not at 21 million yet. We're sort of, I think, 19.5 million, something like that. But there's only 21 million Bitcoin, and then something like 20% of the accounts that own Bitcoin are inactive. Whether someone lost a password or if they passed away, there's a concentration issue where 95% of Bitcoin are owned by less than 3% of the nodes, and that is an issue that drives the volatility. But I think in the long run, I don't think you have a few companies now that are sort of buying and holding Bitcoin, but I think in the long run, it's going to be more along the lines of what can we use DeFi to help our business or to serve our customers. I'll leave it there.
That was awesome. I've got a bunch of questions, so I'm going to hit you rapid fire, Dwayne. If you got 10 seconds of comment or no I have, pass. I'll just hit you with the next question. First one is, can you speak about potential crypto regulation? Any word on the street about there being some sort of regulatory body on all this?
I think regulation ultimately would be a good thing. It's been resisted, and again, when you think about where crypto comes from, it comes from that sort of counterculture ethos. At the end of the day, the short answer is that the regulators don't really understand it that well. And even though they're moving along with this central bank digital currency, that's a very different animal than Bitcoin. So I think that you're probably a ways away from really regulation of things like Bitcoin.
One comment was around, any idea what percent of the transactions are for illegal or nefarious activities?
Yeah, so good question. The estimate is that less than 5%. That number has gone down over time. But again, there's really, your guess is sort of as good as mine. What I would say is you might recall that in some of the spyware that we had, where you had a pipeline was hacked, and there was a payment made of 5 million, 10 million, whatever. The regulators were actually able to track that money, and it was funny because that day Bitcoin prices fell, and it was because the anonymity that's supposed to go along with that was not really there. They were able to recover some of that cash.
Any threat to a supercomputing or AI to the value of these assets?
Yes. And that's the thing. So if you have a strong enough computer power, you can go back and replicate the blockchain, because again, it's just one blockchain. And if you had the computing power, again, right now it'd have to be significantly, technology that really doesn't exist. But you could replicate the blockchain and then ultimately move. Once you have the longest, the way the system works is once you have the longest, the system treats the longest chain as the right chain. So if you were able to replicate, then catch up to the current chain and then add transactions to it, you own the whole chain, basically. So it is absolutely a threat, but impractical in terms of current technology.
You seeing mid-market or larger firms accept payments in cryptocurrency? And then has anybody talking to the treasury departments of firms like yours about crypto fluctuation and hedging, if they are accepting payments or payment terms on POs for future work?
Few and far between. There was a small period of time where you could buy Tesla. There are some places, like if you look at Square, which is a company I cover, they buy and own crypto and they allow you to transact in crypto. PayPal is allowing you to buy, hold, and sell and transact in crypto. They're rolling that out this year. But, again, for the most part, it really isn't. I talked about how ineffective it sort of is as a payment form. And with the concentration in various few accounts, it's really just being bought and and held as a store of value and not so much as a transactor. But there are a few actors that are allowing you to do that, Square and PayPal being most notable.
I'm going to pull one last question that I think is a cool foundational question around really more it's the blockchain technology than it is a currency use of it. To pull the string on the smart contracts that you mentioned, the question is around are there uses to the blockchain technology for farm to table, like proof that the fish that you're buying at the restaurant is really wild king salmon using blockchain technology? You seeing any commercial applications that CFOs should be keep an ear out for, commercial applications of the blockchain?
That would be viable. That would absolutely be viable. I would say that when you think about the smart contracts that drive the Ethereum network, there could be all sorts of use cases, both practical and impractical, and that's the beauty of it. It's basically a blank slate where you can just. I know, for instance, Bank of America, we have thousands of patents for uses for blockchain. Now, will we actually ever use any of those? I mean, I don't know. We'll see. But I think that that's sort of that's the beauty of the Ethereum network and DeFi, is that it is what you make it. And I think I would not have predicted that you would be selling art and people would be buying art using digital, non-fungible tokens, but they are, and they have. So again, sometimes the use cases you can't anticipate, but that's sort of the beauty of the technology.
Jonathan, or Dwayne, any closing thoughts in our last 60 seconds?
I mean, I can just go ahead, Dwayne.
No, you go ahead. Go ahead.
I would just from a macro perspective on cryptos, currencies are like they're proxies for geoeconomic power, right? And so from that perspective, as a macroeconomist, knowing, first of all, I don't understand a lot of this, which I try to be well educated, but I still don't get it, right? These lists of things, it's beyond me. But from a macro perspective, which is the area I know more about, currencies are proxies for geoeconomic power, meaning how sound is your governance? Do you have everything in place to protect your currency? How strong is your economy? What are the demographics? How much liquidity is there? How strong is your financial system? How transparent are you? How much trust do I have in you? These are the reasons the dollar has the exorbitant privilege, right? It's the world's reserve currency because of those foundational things, even a military that gives you ability to protect your country so that you're going to get money back. So currencies are proxies for geoeconomic power. From that perspective, to me, cryptocurrencies are very dangerous in this idea that somehow an emerging market country with an authoritarian leader would adopt a digital currency is somehow a good thing for cryptocurrency is actually backwards, because that will make it even less attractive to somebody who recognizes that currencies are really so advanced in giving you a real-time indicator of a sovereign currency. Maybe that's a different sort of view.
Well, that's a great thought to close on. Dwayne and Jonathan, fantastic job. I thank you both. Both are thought leaders, folks. Great written and audio content online from both Jonathan and Dwayne. I'll share their contact information when I send out the deck tomorrow. And thank you to Jamie and Victor and Latasha with Bank of America. They are awesome business bankers. And if you are thinking about having a quiet conversation, bringing another banker into the fold, I highly recommend Bank of America. And closing, please like, comment, and share my content on LinkedIn. It's one finger. That's all you have to do. And you could be cool and win a great prize like Steve over at Nova Molecular. Everybody have a great day. And Jonathan and Dwayne, thank you very much.